Welcome to Taking the Taxing Out of Tax Credit Housing, written and produced by The Training Factor. This course will provide you with an overview of the tax credit housing world and give you the necessary skills to be successful in your career in tax credit property management. In this first section, you will learn the history of the tax credit program, important definitions you need to know, how tax credits work, and how owners receive tax credits. Let's get started. Let's take a look at the history of the tax credit program. Before 1986, the Department of Housing and Urban Development, also known as HUD, governed all subsidized housing programs. The federal public housing program has the reputation for being a decaying dumping ground for housing some of the poorest families in the United States. In fact, this short history will demonstrate how that program has evolved significantly over time, but was rooted in a very idealistic and paternalistic view of helping the working class, not necessarily the underprivileged segments of society. The purpose of public housing, as well as the financing and design, has changed greatly since the passage of the 1937 Housing Act. Public housing was originally built on a relatively small scale as 2- and 3-story walk-ups and garden apartments, which were financed through bond initiatives and operated by setting rents to cover costs. Beginning in the 1950s, high-rise building styles dominated the program. High-rises failed for families in most cases, but due to its self-contained designs, served the elderly well. By the 1970s, rents were tied to incomes. Tenants were more often poor, and a financing gap emerged, which led to the deterioration of many units. Now that you are more familiar with some of the most common tax credit terms, let's look at how tax credits work. Tax credits must be used for new construction, rehabilitation, or a combination of acquisition and rehabilitation. Additionally, projects must also meet the following requirements. 20% or more of the residential units in the project are both rent-restricted and occupied by individuals whose income is 50% or less of area median gross income. Or 40% or more of the residential units in the project are both rent-restricted and occupied by individuals whose income is 60% or less of area median gross income. When the LIHTC program began in 1987, properties receiving tax credits were required to stay eligible for 15 years. This eligibility time period has since been increased to 30 years.